Red flags are going off across the real estate market, and today we're going to be looking deeply into the history of the real estate market and trying to understand, is this an unsung and potentially disastrous wrecking ball for risk assets like cryptocurrency? You're definitely going to want to watch this episode, as this is a correlation that I've heard very few people even seldom discuss. But the reality is that real estate has been in a bull run for most of crypto's life, especially the most parabolic recent cycles. So today we're going to be looking into the potential for the greatest real estate collapse of our generation and how it might affect our precious cryptocurrency stocks, or really any risk assets outside of real estate. If you're excited for this one, destroy that like button. Honestly, the vibes on the channel have been amazing. Your comments, your feedback have just been superb. The people still here during these tough bear market times, I believe, are the ones that are setting themselves up to find the true best entry points into risk assets. So congratulations to you if you're still here. Make sure you destroy that like button and subscribe, as we're going to be doing our best to bring you the best content throughout these challenging times. With that said, let's dive in. First off, let's get some numbers out of the way. As you can see here, real estate is the biggest asset class in the world. Well, technically, the biggest asset class in the world is derivatives, but derivatives are just fake imaginary bets created by finance bros to completely confuse you while somehow stealing your money. That's not really the point. The point is that besides derivatives, which are products based on other assets, which of course there are real estate derivatives, the biggest asset market in the world is real estate. As you can see here, we have equities at 109 trillion, debt securities at 123 trillion, global debt at 84 trillion, gold, commercial real estate at 32 trillion, agricultural land at 35.4 trillion, and obviously we can just lump all these in here together, and then we have residential real estate at 258 trillion. All together, you have 258 plus 35 plus 32. Yeah, you get a lot of trillions of real estate market. The point is that real estate makes up, between commercial, agricultural, and residential real estate, we have almost half the world's assets in real estate. That means that whatever happens in the real estate market, well, that really is the market. That is the business cycle. So don't mistake one for the other as if they live in some kind of isolated world. Of course, stocks fell dramatically while real estate hasn't fallen yet. But just know, when real estate falls, there are serious consequences. The reality is, though, that real estate bubbles tend to conform more to local geographies instead of entire nations, right? Like there will be maybe a bubble in Frankfurt or Toronto, Hong Kong, Munich, Zurich. Of course, more locally here, we have Los Angeles, Miami, we have Boston, San Francisco, but the point is there are real estate bubbles popping up all over the world. So let's take a deeper look here at what's going on and try to understand what systemic risks might be posed here. Now, this chart gets me because, as you can see here, right when we went off the gold standard, right in about 1971 or 3, I forget the year, but you can see here that the value of homes has increased dramatically more than income, which has more or less stagnated, but we see the value of homes going parabolic. And it really begs the question, are homes the new gold? Has real estate kind of supplanted the value of gold and how gold is traded, this sort of asset that hedges against inflation and really is the number one safest way to store your money? Well, the reality is that it seems as though since we went off the gold standard, home change in value has gone absolutely ridiculous. Keep that in mind as we go to compare things like cryptocurrency to gold and real estate to gold. Again, the thesis of this isn't that real estate is the new gold. I'm just saying it's really important to understand how dramatic the pricing increases have been. Now, it's important to note that of all the countries in the world, the biggest real estate market by far is that of China. China has also been experiencing a dramatic reset and collapse of their real estate market. Now, China has a cultural custom of collecting real estate. It's very common for households to own more than one piece of real estate, as there was not as much trust in their securities markets, in their stock markets over past decades. And so culturally, people are more likely to invest in real estate. Therefore, the real estate market in China is the market, and any kind of reset there affects everyone dramatically more than even the stock market would. It's also important to realize that China has been in a real estate disaster. I'm sure you heard of Evergrande, I'm not actually sure how it's pronounced. The point is that major real estate conglomerate and its default on its debts, its struggle financially, has been one of the biggest issues threatening contagion across the entire Chinese economy. And the Chinese economy is so interwoven globally that it's said when China sneezes, the rest of the world gets a cold. That's also said of the United States, but it's important to realize that what's going on with the Chinese real estate market is in many ways a leading indicator. China has been leading the world in a variety of ways. They dealt with COVID first. They've now dealt with the real estate collapse first. And even though they say that things are more or less contained within the Chinese real estate market, we could just be seeing the canary in the coal mines of a much more significant cyclical reset. Now, these four charts also show not only how bad the Chinese real estate market crisis is getting, but how it could get worse. As you can see, the residential mortgages here are in black and the Chinese developer loans are in red, and these are in trillions of yuan. As you can see, the Chinese banks are heavily intertwined with the real estate sector, so any kind of collapse in the Chinese real estate sector could spell big trouble for the banks. I'm sure you saw the videos of Chinese protesters who were storming banks who had frozen their assets just weeks ago, and this could be a sign of a lot more pain to come. As you can see, there are two major banks in China that exceeded the regulatory cap on the percentage of exposure to residential mortgages. This means that they are overexposed to the sector, again, spelling that if things are to collapse in the Chinese real estate market, banks could start to see some major trouble. We also see China's debt to GDP ratio set to climb to a record high this year. That means they're sitting on an incredible amount of debt, and an overabundance of that debt is in real estate. And finally, you can see the home market slump is deepening. As you can see, property investments and home sales are both in the negatives of percent growth here over the recent months. Full stop, this is a terrible set of facts for the world's largest real estate market and one of the world's greatest financial superpowers, China. But this isn't just a China thing. You see, China might be ahead in their cycle, but they're not the only ones experiencing trouble. The United States has a ton of red flags and warning signals. We all can acknowledge that housing prices in the United States have been in total bubble territory of late, but now we're finally starting to see cracks in the armor. Average home price is down 12% in 2 months, which is the biggest drawdown in history. That's right. Mortgage demand is at its lowest since 2000. Housing supply is up for the first time since 3 years ago. Home sales are down 16%. 15% of all sales fell through in June. And according to this one tweeter, the housing market party is over. As you can see from this chart, the amount of homes that are slashing prices has surged to the highest level in the last 7 years. As you can see, this chart looks like it's headed for new highs. People are slashing prices like crazy and demand is dropping through the floor. It's about to become a buyer's market, but the question is, how bad will this get? And we showed this chart, which effectively shows the 2-month change in median price of new single-family homes that has cratered now to 11.9% in the negatives. As you can see, the tip of this blue line is lower than anything since the 1970s. It's actually lower than that 1970 read. So as you can see here, this is one of the biggest collapses in price in the history of homes. But of course, this followed one of the biggest increases in price in homes in history, and that came over the last 2 years. Consistent growth throughout the COVID pandemic, free money printing bonanza, which sent home prices into unbelievable, sort of unsustainable territory. Now, as Eric here says, volume of new home sales is crashing, down 43% from the peak. Don't forget that housing is the business cycle. And I think people like to separate business cycles from housing. Housing's just one market, stocks are another market, commodities another market, crypto, art. The reality is yes, they all are different markets, but housing is the market. And remember that when housing gets into trouble, it affects absolutely everything else, which is the point of this episode, is that housing does not live in a bubble. Housing affects literally the wealth of most people around the world. And of course, it's going to impact consumer spending and the consumer's desire to take on risk in sectors like cryptocurrency. So according to Alf here, there are 3 steps in market weakness for housing. The first is additional leverage, which is mortgages, which first they become unaffordable and people say it doesn't matter. The market is healthy. There's demand. There's not enough supply, so on and so forth. Then we have stage 2 or B, as he said, volume of sales drops and housing supply dries up. People say it's temporary. And then finally you have price cuts at the lower end and then the higher end. And he says today we're at B. Now, of course, the political rhetoric around all these things is always designed to, more or less round out the rough edges of the economy. They don't want to cause any kind of panic because so many people have their net worths tied up, their perception of their own wealth, which is a really important topic that we'll talk about, but their own perceptions of their own net worth is tied up in the housing market. So calling it a housing collapse or a crash or any kind of combination of words that cause panic is not what they want to put out there. So it went from calling it a housing bubble to an affordability crisis, and it went from a housing crash to a housing downturn. The point is, demand is dropping everywhere. So is this a 2008 throwback TBT where we have foreclosures across the nation? Well, not really, because since that era, the average credit score behind a mortgage has increased, and actually the percent of total mortgages having a credit score of 760 or above is actually 69.5%. That is a monster amount of new houses going to the highest quality, highest credit score bucket of borrowers. And that means that we have a significantly diminished risk of a complete and total collapse, where effectively people are just unable to pay their mortgages across the board. We don't have as much subprime nonsense as we had in 2008. We also have groups like Blackstone preparing a $50 billion fund to snap up real estate during the coming crash. So maybe the whales are there to buy the bottom, and there is strong support around the prior all-time high. Of course, I'm making a little bit of a crypto joke here, but the reality is it's not just millennials that might look to buy their first home here during the crash. But this chart is one that I want you to keep in mind because inflation is causing all of these problems. In 1970, it only took 2.5 years for the average person with their normal labor, their normal work product to save for a home. Now it takes almost 7 years, or about 7 years. That is inflation, and what it's stealing is your time. It's stealing your ability to actually have a stable life. Whereas before it was a couple of years, now it's almost a decade or the better part thereof. And that means that we have a serious issue with housing, no matter which way you slice it and no matter which way the market is going. The CEO of the National Home Builders Association believes we're already in a housing recession. And this chart shows that the percent change, the rate of change in monthly supply is now ticked up to a record high. And this is, of course, with slowing demand. And this means that 18% of the nation's GDP is now at risk. That is a huge amount of GDP, a huge amount of productivity that is now going to be at risk. And if this, of course, comes into a proper downturn or a recession, that means that the amount of money floating out there in the world will certainly not be available for things like risk asset markets, like cryptocurrencies. The amount of global liquidity in the world is highly correlated with an increase in value of cryptocurrency. So let's recap. Housing has definitely been hit in China, and it's looking like it's slowing down dramatically in the United States. Housing is also a lagging indicator. It lags behind leading indicators like the stock market and other types of more fungible assets. But the reality is that the COVID housing bubble party is clearly coming to an end, and that this era is now turning into one of at least a correction. However, how deep that correction goes could deeply affect the wealth and prosperity and appetite for risk for people across the nation. And of course, as Americans stop spending, it is a huge notch down in the global economy productivity. Real estate cannot be ignored. It is the behemoth of all asset markets, and any kind of macro downturn will certainly spell out some serious headwinds for any kind of risk asset markets. However, the silver lining is that stocks and crypto might find their bottom long before real estate. So selling real estate and buying into crypto or stocks, or riding crypto and stocks up as real estate continues to try to find its ultimate lows, is something that could actually be an equation we find ourselves in, where we could be making money in crypto and stocks, preparing to truly buy the bottom if you're looking for your first home, or just an investment property to diversify out of cryptocurrency and stocks if you're someone who has most of their wealth tied up in this market. The reality is that this is a very complex situation, but one thing is certain: we must keep our eyes firmly fastened on the real estate market, which is taking a significantly longer time to work its way out than stocks and cryptocurrency. In future episodes, we're going to be examining the relationship between cryptocurrencies, gold, and real estate, and trying to find a sense of where the world is going and how we can best benefit from these changes in the world financially. If you guys enjoyed this episode, destroy that like button. As always, we're going to be bringing you the absolute best content we can throughout these bearish times, as these markets are filled with opportunities that most people spend years dreaming about. No matter how scary the macro economy is, there are opportunities that present themselves in these downturns, and those that plan, understand the markets, and position for the long term can benefit disproportionately. As always, I hope you guys enjoyed this episode. Smash that like button, make sure to subscribe, put that bell notification on, and sign up for FTX today. You get $15 off your first trade if it's worth over $150. As always, my name's EllioTrades. You can find me on Twitter at EllioTrades, and I'll see you very soon on the next episode.